Hello and welcome. Multi-asset funds often promise balance, diversification, and peace of mind. But do they truly deliver, especially in today's complex markets? Well, with the launch of new fund, we speak to Raghav Iyengar, CEO of 361 Asset Management, to understand their unique approach and who this fund really is for. Welcome, Raghav.
Thank you so much for having me on this show.
Great to have you here. Let's begin this conversation with, multi-asset funds are often called all-weather portfolios. But when you say multi-asset in this context, what exactly goes into it and how much flexibility do you really have in moving between assets?
That's a lovely question to start this conversation, Vijay, because most multi-asset funds are, if you remember, more equity tilted, right? I mean, they are largely equity plus a little bit of commodities plus a little bit of fixed income. At 361, we sort of analyzed this problem and we figured out there are a lot of investors who require decent returns with slightly lower levels of volatility.
Right.
The only way you can do that is by trying to give them a reasonable allocation across all the asset classes possible. So in our offer document, we have kept deliberately 15 to 35% in equity, right? 10 to 50% in debt,
Okay.
25 to 40% in commodities, which in this case is gold and silver, and 0 to 10% in InvITs and REITs.
Okay.
Within the equities portion, there is an application that we have made. There is a possibility of putting some funds into work in foreign equities, which is not there today because of the non-availability of investment limits. But hopefully someday, whenever that happens, within that 15 to 35, the fund manager will also have the ability to buy some level of international equity at that point of time. So as you can see, the construct of this portfolio gives you meaningful allocation to the three big asset classes today, which is equity, fixed income, and commodities, which is gold and silver. So I think by doing this, your ability to get decent low volatility returns increases multifold.
So while you did mention that other multi-asset funds are high on equity, whereas yours is, balanced distribution between equity, debt, and commodities. But
Correct.
since there are so many multi-asset funds already in the market, what else from this sets apart your fund, whether in terms of philosophy or how it's managed? Asset mix, you already told me. So is there anything else?
I think the important thing also is that we have a very structural way to review these asset allocations. As you know, within this fund, there are three people actually managing this fund.
Okay.
There is Mayur Patel, who looks after our equity portfolio. He is responsible for managing our flagship funds like the 361 Focused Fund and the 361 Flexi Cap Fund. We have Milan Modi, who looks after our fixed income portfolio. And we have a gentleman called Mr. Rahul Khartawat, who looks after the commodity portfolio. Now, the idea is obviously each of these people are specialists in their own fields, but we have an asset allocation committee, which is headed by our CIO, Anup Maheshwari. I am also a member of it. You have the economist who is a member of it. And this committee essentially looks at a lot of data, looks at a lot of the macro factors, and then in turn, collectively, we decide what should be the allocation within the limits that I just spoke about for the fund managers to use in their respective areas of investment. So we've given a lot of independence to the respective portfolio managers to do what they have to do within their portfolio, but the overall construct is designed to be optimum by looking at a host of macro and other factors too. That's a fairly unique proposition in today's world.
Yeah, right. So, will this be model-based or more macro-driven, or it's just this the discretion of this committee that will decide the split?
I think there is no we've tried to put as much flexibility into this because I think in today's world, which is we calling it a VUCA world, it's really VUCA is a very old term, as you know, it's volatility, uncertainty, and there's so much of it happening around. So I think one way to deal with all of this is to be able to be flexible across various asset classes. So we don't have a prescribed model that at this time this will happen, but as you can see, we put these bands into play, which is 15 to 35, 10 to 50, and obviously 25 to 40, and then 0 to 10. So we've given adequate representation to each of the big asset classes in the asset allocation itself. And of course, the asset allocation committee will largely decide as to how much of what goes into each particular bucket. But within those buckets, the fund manager is largely okay to do what they have to do in terms of stock and sector selection.
Okay. Now let's talk about equity first. How do
Right.
you go about picking stocks there? And will it be a broad based portfolio or something more focused on high conviction bets or certain market caps?
So the 361 equity philosophy is largely is called the SCDV approach. So the idea is to try and find companies which give you very, very good return on equity. Typically, we try and look for companies which are consistently able to give you 15% ROE across a long period of time. We are also big believers of PAT growth. So we try and marry these two, which is PAT growth and ROE. That's the core of our thesis. Companies which are able to meet both of these are called secular. And then, of course, there are companies which are unable to meet the PAT growth part, but which are very good on ROE. They are defensive. Companies sometimes meet the PAT idea, but they are not able to meet the ROE. They're called cyclical. And of course, there are companies which don't meet both. We call them value trap. So this is the full form of SCDV. We are a high conviction bet company. Lots of our ideas will flow towards the secular side. But having said that, I think there is no sector or a stock cap that we are not going to look at. We are really pretty much bottom up managers, right? So, in fact,
Right.
some of our best ideas have come from value traps, especially when we see them progressively making a move towards the secular category because of changes in fundamentals and stuff like that. So, in that sense, I won't call us a value style or a growth style. Okay, typically, that's what happens. But yeah, we are high conviction and broadly around this SADV framework. Yes.
Right. So, Raghav, what happens is that a lot of investors they think of debt and gold as safety nets, but
Yes.
we've seen times when all three of them, equity, debt, and gold, they can underperform together. So, how will this fund handle such phases?
There are periods, and I completely agree with you. There are periods like last year where all three actually went up together at the same time. So you had equity and debt and gold doing really well in 24, 25, right? And actually equity not so much, but debt and gold typically too. But if you look at historically, we have seen that gold is a very, very good play between equity and gold.
Mhm.
So in periods of extreme stress and extreme volatility, we will try and move portfolios more towards high quality debt and obviously precious metals because these are very, very good defensive plays against sharp moves in equity. And we did some work. So we found that a portfolio of this construction, which is typically around 25% equity, 25% gold and silver, and about 50% debt, actually has given no negative returns on a 2 year rolling basis.
Okay.
And interestingly, has been able to deliver more than 7%, 80% of the observations at much, much lower levels of volatility. So that's what the construct of this portfolio allows you to do. That in extreme stressful times, you can really bring a lot of defensives to play in the form of high quality debt or precious metals into the portfolio and do it pretty much real time.
Another pitch when it comes to multi asset funds, we often hear that they help investors stay invested. So, from
Yes.
your perspective, what
Yes.
kind of behavioral edge do these funds really offer?
So essentially, the biggest behavioral edge, Ruchira, is that they really reduce your levels of volatility.
Hmm.
Most investors, especially of course, thanks to work that people like you in value research have been doing, I think investors have got comfortable with some levels of volatility. And we've seen that behavior, especially since post-COVID. And every time market gets volatile, I think in fact there's a slightly renewed interest among retail investors. And I think that's compliments to you and the rest of the education community to really do that. That would never used to be the case if I go back 10, 12 years back. And I think full marks to the regulator and the AMFI for it. But if you have a situation where you're going to face extreme volatility over a long period of time, it tends to create stress in the minds of investors, especially first time investors who have a certain assumption that their equities or their investments will do something for them. This product effectively manages to do that because in periods of extreme stress, like I said, the portfolio managers can move the portfolio to very, very defensive instruments like high quality debt or towards gold or towards take tactical calls in silver and maybe even place some money in InvITs and REITs, which are very, very good yield bearing assets. These act as a great counterbalance to any sharp equity movements. So this sort of smoothens out, if I may say, your investment experience. Now, if you have a reasonably smooth investment experience, investors do tend to stay invested, and more importantly, they tend to top up their investments also. So I think that helps a lot in an environment like what we are going through today at this point of time. Apart from that, let's say even in a non-volatile world, let's say things are going very well. Let's say a recent example could be maybe 23, 24 period. Even in those situations, thanks to the multi-asset allocation approach this product has, or the scheme has, that also tends to give the investors a very, very smoothened out investment experience. I think that's the critical thing in this product, that we are trying to optimize your returns but reduce the level of volatility in the portfolio.
Raghav, in what circumstances do you see multi-asset funds not performing well? If you could elaborate on that a little.
Yeah, specifically the 361 multi-asset, which as I said has a bit reasonable allocation to all three asset classes, right? Which is debt, equity, and commodities in the form of gold and silver, and a little bit of REIT. So this is more a defensive multi-asset, if I may categorize it, right?
Right.
But yeah, where will this product not do well is, let's say, a multi-asset fund which has maybe much higher allocations to equity, and the equity portion really takes off. Like maybe you have a COVID bounce, like what happened, where suddenly in a matter of months, the portfolios were up in 25-30%. Those are periods where this product will struggle to catch up in terms of performance. But we're really looking at a very different investor audience here. As I
Mhm.
said, the investor who's coming in here is really looking at this as a core allocation. They're not really looking to make 20-30% return in this portfolio. This is more a fixed income plus kind of a return. It's a great place to park something which you know you need in the next 3 to 4, 5 years without too much level of volatility. So that's one big circumstance where I think these products could do not do that well. There have also been periods, as you know, where gold has done in terms of price movement nothing for some periods of time, and
Yes.
then suddenly it tends to do very well. But to offset that, we've got silver. So our ability to take tactical calls in silver is there. So between silver and gold, I think that will do the job in the commodity space. Yes. So yeah, that's broadly the one big one where it doesn't do well is maybe when you have a blowout market in equities. So this
Right.
product is not designed for those markets. I think, but
Sure.
if you ask me, somebody who's looking to make money there, I think should really look at core equity funds itself, like, and
That's
not get into a multi-asset fund at all, basically.
yeah. Right. So one last question, and one that most investors look for. Who is
Hmm.
this fund really meant for? Is it better suited for conservative investors looking for diversification, or for aggressive ones who want tactical asset rebalancing without doing it themselves?
And that's a lovely question to end this session because, yeah, I think today, if you can see what I've been saying is that this is largely a fixed income plus kind of a product. So anybody who's looking for lower levels of volatility, which fixed income tends to do, but with higher post-tax return, this product can be easily considered. It's a great product for somebody who wants to start his or her investment journey because they would not want to get that level of volatility and obviously try to aim for more predictability. It's also great for somebody who's trying to build a corpus for short-term needs, say anything which is 3 to 4 years ahead, say a children's education or a retirement corpus can be easily thought about. This product can be easily thought about. Lastly, even for aggressive investors, this can be a really core part of your portfolio because even aggressive investors tend to have some part of their money in defensive assets, and this product can really fit that requirement very comfortably. So as you can see, it's a like the name suggests, it's a multi-asset fund, but it's also a multi-use fund. It's
Mhm.
not only for a specific need or a set of investors. It can fit needs of any investor, be it aggressive or conservative, right? It's completely up to what their time horizon is, their level of volatility, their level of predictability. And I think it's a great place to keep what I call a bit of a safety pot money away.
All right. Well, with that, we'll wrap up this conversation. Thank you, Raghav, for joining in and sharing your insight.
Thank you so much, Shirja, and thank you, Value Research, for giving me this opportunity. Thank you very
Thank
much.
you.